Welcome to Learn CFDs, and today we're going to take a look at two numbers that guarantee your success. These are the risk reward, which is your average win divided by your average loss, and your hit rate, the number of wins divided by the number of trades. So the risk reward is how much you win when you win relative to how much you lose, and the risk reward typically should be greater than 1. The hit rate is the number of wins divided by the number of trades, so this is how often you win when you do win. So when you trade, how often those trades are profitable. But it's not one number or the other that determines the outcome of a profitable strategy. It's the combination of the two. Now look at a couple of examples that demonstrate this. If we put these together correctly, we can have profitable trading. Now, has anyone ever bought a Lotto ticket? Most people have. And the reason is you can win $10 million for just a $10 ticket. So the risk reward here is fantastic. In fact, it's 1,000,000 to 1. Now there's no trading strategy I know of that makes these sort of returns. But the problem with this is not the risk reward, it's the hit rate. How often do you win? Well, if you look at the numbers, it's 1 in 3.8 million times. So is this likely to be profitable? Well, once we're going to win $10 million, but 3,838,379 times we're going to lose $10. So overall we're actually going to lose $28 million playing Lotto. Luck does play a part in Lotto, and it's possible that it isn't the 3 millionth ticket that you buy that actually wins. But good trading is not about luck, it's about having the odds in your favour. Now in Christchurch, New Zealand, there was a rugby game played by the Crusaders there, where someone bet $100,000, and if they won, they were going to win $108,000 if the Crusaders won the game. Now they've dominated the competition over many years, but it doesn't look like the greatest sort of bet. The risk reward on that is 1.08, so it's not fantastic. But if the Crusaders win often enough, if the probability is high enough, it could actually be profitable. And the probability of them winning is an unknown. But imagine the hit rate, if it was say 95%, there was a 95% chance of them winning, then the profitability 19 times would win $8,000, once would lose $100,000, so overall this strategy would actually be profitable, making $52,000 overall. So here, even though the risk reward is lousy, it is possible that the strategy could be profitable, provided the hit rate was high enough. So let's look at some market setups in the Australian market. Hit rate of 78%, risk reward of 1.85. Is that likely to be profitable? Certainly seems that way. Another one, hit rate 70%, risk reward 1.92. Again, a good chance that could be profitable. And the hit rate's 85%, risk reward 5.16. That's definitely going to be profitable. We can find a strategy like that. And if we do the maths, in the first case, up here we've got 0.78, so 78% of the time we make $1.85, and 0.22% of the time we make or we lose $1. So overall, for every dollar we invest, we make $1.22 profit. So $10,000 in, $12,200 profit out. Certainly profitable. This one here, doing the maths again, comes up at 1.04. So here we make $1.04 for every dollar we invest. $10,000 in, we make $10,400 profit. And the last one looks pretty good. 85% chance of winning 5 times, 5.16, and a 15% chance of losing 1 unit. Now here we make 4.23, so for every dollar we invest we make $4.23. $10,000 in, $42,300 profit. Certainly profitable. And these are quite simple strategies. They're simply buying the Aussie 200 on the 12th of March and selling on the 15th of May. Buy it on the 28th of June and sell on the 8th of September. And buy on the 19th of December and sell on the 31st of December. If you'd like to learn more about these setups, then take a look at the videos on seasonal setups. But you can see the combination of the two numbers, the risk reward and the hit rate, is essential to profitable trading. I wish you successful trading.